passive buy and hold strategies of the last decade now face three specific massive economic shifts arriving in 2026. We are seeing a rapid evolution in artificial intelligence, a shifting global power map, and real estate markets behaving in ways we haven't seen in decades. These forces are changing how capital must be positioned to remain effective. Welcome back to Minted Mosaics. Rather than relying on outdated theory, we are going to look at the smart money movements to build a definitive, actionable execution plan for your portfolio. To begin this process, you will only need a standard brokerage account, a tax-advantaged account, and a willingness to adapt your current strategy. Following this blueprint is designed to transition you from a passive position into one that targets the high growth drivers of the new economy. While much of the early AI boom focused on software startups, institutional capital is now prioritizing the physical infrastructure that makes that software possible. This follows the classic logic of a gold rush. Wealth often concentrates with those providing the tools. In the AI economy, those tools are data centers, advanced semiconductor chips, and the immense energy grids required to power them. To execute this shift to physical tech, use your brokerage to identify semiconductor and cloud infrastructure ETFs. These hardware facilities rely heavily on the power grid. Next, find utility and energy sector index funds to capture returns from massive electricity requirements. By focusing on infrastructure, you are investing in the essential components of the AI boom, which avoids the volatility of picking individual software winners. Relying exclusively on Western stock indices may no longer be sufficient as global growth and middle-class expansion move toward India and broader Asian markets. This requires a shift toward tactical allocation, the deliberate maneuvering of capital into specific regions where domestic demand is increasing most rapidly. Capital is concentrating intensely in the East. Use your brokerage to identify a broad emerging markets ETF or an Indian market fund. For a balanced approach, reallocate between 5 and 10% of your total portfolio into these specific emerging market funds. Positioning capital in front of an expanding foreign middle class helps insulate your portfolio from periods of slower growth in domestic markets. New infrastructure projects like expressways and tech corridors are creating localized demand spikes and driving high premiums in the luxury real estate sector. Direct property ownership can be slow and capital-intensive. Real estate investment trusts, or REITs, offer a more liquid way to target these specific high-growth property types. The first step is to open a tax-advantaged account, such as a Roth IRA. This ensures the dividends you collect from these properties are shielded from future taxes. Using your search screener, look for REITs that hold luxury residential formats or premium commercial spaces in tech-heavy regions. This strategy allows you to capture high-tier rental yields through a tax-efficient structure without the burdens of direct property management. Trillions of dollars in government and institutional capital are currently flowing into clean technology and green energy megatrends. To align with this funding, look for green bond funds or ETFs that focus on the ongoing global energy transition. These funds are often composed of companies that benefit from long-term government contracts and specific tax incentives designed to accelerate adoption. Because this sector can experience price swings, set up an automated, recurring monthly investment. This creates a smoothed median entry price, regardless of market timing. By using automated investing to partner with these heavily funded government trends, you turn market volatility into a structured long-term entry strategy. Rapid shifts in technology and global geography often bring periods of market volatility and fluctuations in currency values. To balance these risks, investors often use physical gold and silver as a stabilizing asset, primarily because they carry zero counterparty risk. Purchase physical precious metals from a reputable dealer and store them entirely offline in a secure deposit box. For the digital portion of your portfolio, allocate 5 to 10% to a physically backed gold ETF. Avoid paper futures, as they do not represent a claim on the physical metal itself. This allocation serves as a core of the portfolio that remains independent of broader market or currency fluctuations. You now have the framework for a portfolio built on 5 distinct pillars, moving away from a reactive strategy to one that accounts for current economic realities. In a rapidly changing environment, holding on to a single rigid strategy can leave a portfolio vulnerable. Success depends on the ability to adapt as new data emerges. To see how these investment principles look in practice, we can look at the physical assets that top-tier REITs and private investors are currently acquiring. Click the video on your screen right now to watch inside $50 million dream homes and see these luxury real estate principles in action. Thank you for watching, and I will see you in the next video.